All right. So today we'll be talking about trading plan and the importance of having a trading plan as you trade. So let me go on the chat. Um, all right, good. So today we're talking about what we call a trading plan. So now, what is a trading plan? So we can say that the trading plan is a comprehensive decision-making tool for your trading activity. What does that mean? It means that as you learn about the strategy, the market section you want to trade, you know, the what's it called, the pair you want to trade, and so on and so forth. You need to have a trading plan where whenever you're about to go into the market, you have something to guide you on making trading decisions. So, what does your trading plan help contain? It contains what you want to trade, what you want to trade. Okay, that's wrong. What you want to trade, when you want to trade, and how much you want to trade for that day. Now, these are what you need to have in your trading plan. And a trading plan should be your own personal plan because someone else's risk percentage or someone else's risk appetite cannot be the your own risk appetite, meaning how much you are willing to risk for that day. So that's why it has to be your own personal plan. You could use someone else's plan as an outline, you know, to get your trading plan to formulate your own according to what you have used to trade. But someone else's attitude toward risk and the available capital that they have in their account is will be different from what you have as an individual. So you best you formulate it according to your own, appetite to trading. So now, what should your trading plan include? What should your trading plan include? First of all, it has to include your motivation to trading. Meaning that why are you trading? That's the first question you should ask. That's your motivation. Why are you trading? Should be number one. Let me edit this. So I put number one at the first. Why are you trading? Then number two, you should have the time, like meaning the time that you can spare to trading. the time commitment you want to make. Meaning that how many hours in a day do you want to trade? Like you have 24 hours in a day. What market section do you want to trade? How many hours is that particular section open for? So that will help you decide how long you want to be in the market. You know how long you want to keep looking at the chart, and also the time commitment is also how many days in a week are you going to be trading? Are you going to be trading 2 days in a week or 3 days in a week? For me, I trade 3 days in a week. So that I don't really keep going into the market looking for every setup and then blowing my money continuously. Because if you don't have particular days where you trade, you keep going into the market and giving the market your money. So that's it. You have to have that in your trading plan. So also you have to have in your trading plan your trading goals. Mm. Your trading goals, number one. So now your trading goal should be how much are you willing to risk? Your risk percentage in a day, your risk to the reward ratio in a day, your and your daily target in a day. These three are the most important one you must have because your risk to reward ratio, your risk percentage number one, helps you decide how much in a day, how much of your account in a day are you going to risk. If you've, taken a loss more than what your initial risk percentage should be, you stay off the market. And the other one is risk to reward ratio, meaning how much are you risking and for what exactly? So risk to reward ratio has to be, let's say, um, you have a $50 account, so $50, and then you want to use $10 out of that account to trade, meaning that you'll be left with $40. So now $10 of your account is what you plan to use here. So it has to be times two because you cannot risk $10 and want to get $10. Imagine you going to a bank and then giving them your money. If they only give you a little bit of interest by the end of the month, it should not be favorable. It's not be worth it. But the one that is best is if you have a 1 to 2 risk to reward, meaning that once you reach $10, you're likely to make back $20 as your profit so that you can be scaling up your account. Sometimes it's best to use $10 to make like $30. That's 1 to 3 risk to reward. So this is 1 to 2, and this is 1 to 3 risk to reward ratio. That's what risk to reward ratio mean. So using a particular amount of money and getting times two or times three of it. And it's best to be realistic when setting your risk to reward ratio because the market cannot always go in your direction. So you have to learn how to pay yourself when the market makes money available to you. That's very important because one of the trading mistakes you can make is leaving money on the table. I've experienced that most of the times. But having this set risk percentage, risk to reward ratio, and daily target gives me structure and a plan to follow. So that's why the trading plan is very important. And having a trading plan really helped in my trading, you know, so that I have a direction. I don't just come into the market without knowing what to do. Because whenever you place a trade, you have no idea what the market is going to do next. You only have you only know what you are going to do next. You have to react to the market because the market is just moving. There are so many participants in the market. So having a trading plan guides you, in an environment where anything can happen because when you're trading, you're in an environment where anything can happen at any given time, any given point in time. So that's one of the importance of having a trading plan. So for a daily target, let's say now, like I used as an example, I used let's say you had $50 and then you're risking $10, uh minus $10. Let me use minus $10. That means your new balance will be $40. So now this is your risk percentage, $10 for the day. You can as well split it. This $10, you can split it into two positions so that you have $5 on a trade. So that if one does not go, another one will go. So far is my screen not sharing. Okay, share my screen. Share. So now back to it. So like I said, $10 will be your risk percentage for the day, meaning that your new balance will be $40. So if you've lost $10 for that day, you're going to stay off the market. So now that's what it is. So $10 will be your risk percentage, $10. The risk to reward ratio, like I said, if you're risking $10, you have to have like times two, which will be $10 to make uh $20 or $10 to make $30. So that's the risk to reward ratio. So whenever you hear RR, know that they're talking about risk to reward. So this would be 1 to 2, and this would be 1 to 3. So having this is very important. You understand? So if you've lost $10, which your risk percentage is still of the market, right? Then if you after using $10 to take a trade, the risk to reward ratio has to be like 1 to 2 or 1 to 3. Then your daily target. So now your daily target should be in this section, 20 to $30. So meaning that when you've gotten to when the market has given you at least $20, which is 1 to 2 risk to reward ratio, if you're using $10, yeah. If it's giving you $20, you take your $20 and you leave the market for the day so that you can compound. I know that sometimes having a daily target does not suit everybody because you want to make much more money in the market. It's difficult to follow your trading plan, honestly, but having that discipline to follow it will help you scale up in trading. You will discover that all the problem you think you're having revolves around your trading plan, revolves around your discipline to follow your trading plan. That's it. So I've used that as an example. And like I said, if you have 1 to 3, and let's say the market gives you 1 to 3 will give you $30, right? So now let's say you see $25. Let's say you have $30, which is your daily target. Yeah, $30, your daily target. And then the market moves in your direction and then gives you $25. And you're seeing that there's already a retracement in the market. The market wants to start retracing and it's just giving you $25. What do? You take your profit, you close for the day. Markets cannot always give you what you want. So you have to be able to learn how to pay yourself when the market makes money available to you. So this skill and discipline, these are the skill you have to learn in trading. So now the next one on that I have is your attitude to risk. I think I just talked about it. You should be able to risk what you can afford to lose. That's what attitude to risk means. Be able to risk what you can afford to lose in the sense that once you risk money, whatever you're risking, yeah, your it will not affect your psychology after you risk that money. Why? Because if you are risking more than what you can afford to lose, it's going to affect the way you're seeing the market. It's going to affect the way you're perceiving the market information. Because then that's when fear will step in. Fear because you've leveraged your account. Fear because you've not accepted that risk that you put on that trade. But let's say now you accept that risk that you put on that trade, and the market is even retracing. Okay, you have an idea of what you're risking. But let's say you don't know what you're risking. You're just opening lot size, stacking. Now that's one thing about flipping. Yeah, when you're flipping or whenever you want to flip an account, just have it in mind that okay, there's a liability, there's a 50% time that I can blow this account. Not even 50%, 99% chance that this account that you want to flip is going to get blown. Why? Because now you're not calculating your lot size, you're just trading as you see fit. That's it. So you have to be able to accept the risk you're putting on each and every trade you're taking. The number five should be your available capital for trading. So now your available capital for trading is very important. Why? In the sense that let me type that out. Your available capital for trading. Your available capital for trading should tell you how much of that your account you want to risk. So let's say you have a $1,000 account, and you want to risk, let's say, 10% of that account on each trade. So if you're risking 10%, um, let's say 10% because 10% is $100 or $1,000. So now, meaning that you have 10 tries for that account, for that $1,000 account. Meaning that each trade you're taking will cost you in a day, like this one here, this is what you're going to be risking in a day, so that if you minus $100 from $1,000, you have $900. So you have 10 trading days to trade that particular account. You understand? So now your available capital should determine how much you're going to risk so that you have an opportunity to trade another day because each trade you take has a 50% chance of going in a direction. Mm. Now, this is the point where most traders don't most traders don't follow the plan. Like they don't follow the rules that they set for themselves because they are greedy, because they are undisciplined. You understand? So you have $100 now. You've lost 100, like as you take a trade, you've put $100 as your risk percentage for that day. Now, after losing that, you start to trade more than what you're supposed to lose. Then you start to fuck up with your psychology. Like I said, you ask it to risk. So that's the thing. That's why you have to have these rules in place. Everything is what is going to be contained in your trading plan. So by having this, you have to use that to develop a proper money management rule, a proper risk management rule. Let me say that a proper risk management rule, a proper risk management rule. Having a proper risk management rule will guide your decision making in the market, which will not make you, over risk. Those trading mistakes, the most common trading mistake that we have is number one, not predefining your risk, not predefine your risk for every trade you take, not cutting your losses short, not cutting your losses short, not systematically taking profits. Systematically taking profits when the market makes money available to you. These are the most common trading mistakes. I'm right here. Common trading mistakes to avoid. These mistakes, not predefining your risk. Most traders out there don't predefine their risk before they take a trade. That's why they get, you know, afraid. They are not sure of their analysis. I'm sure that most of you that have been trading before this realize that there are times where you take a trade. Oh, there are times where you take a trade and then you after placing that trade, you get scared. You see the market going back to your entry point, and then you start being afraid. You want to close. After closing that position now, you see that the market is going your direction. You're like, is it not because I don't know how to trade? I know how to trade, but what's going on? It's my psychology, my psychology, my It's not a psychology. It's the way you set your risk management rule. Because if you have your risk management rule in place and then you've accepted the risk beforehand, whatever the market is doing does not concern you. If it's your stop loss, you stay out of the market for that day. If it goes your direction and almost at TP, you take your profit. Like I said, first one, not predefining your risk, having your set risk percentage, right? Not predefining your risk, the first one, which may let you over leverage your account, not systematically taking profits, meaning that if market has given you at least one to two or 1.5 of your account, you don't take profit. Then the market now come back to your entry, you now close at break even. Or not cutting your losses short, meaning that after you've taken a trade, you now start to, over leverage your account again, start to go more, go more, go more, go in. You want to revenge trade. Those are the things. Those are the common mistakes that are in trading that having a trading plan helps you avoid. So the next one is the markets you want to trade. Now, this is very important because if you have to have a particular pair in mind that you want to trade, that you understand the the movement of that pair. And like me now, I mostly trade GBP USD. Why? Because that is where I have back tested, I have understood, and I know that okay, this is how this market moves. Oh. Okay, the markets you want to trade rather I wrote through. You understand? So now having this written will help you a lot to guide you in your trading. So every day you come to the market, you know the market you want to trade. You don't just go from one pair to the other. You spend time and develop a relationship with that particular pair you want to trade. Like me now, I've developed a relationship with trading GBP USD. I'm looking to transition into trading gold, but I'll still keep trading my GBP. I'll just be back testing gold small, small, understanding how gold moves. So the next one is your strategies. Now, strategy is what we're going to be talking about next week, but having a trading plan, it has to contain your strategies, meaning your confluences at which you find a point of interest where you want to, you know, buy yourself, risk your money. Then number nine, this one is very, very crucial. Steps for record keeping. What do I mean by step for record keeping? You have to have a personal journal. You have to have a book. You have to have a book where you record every trade you take. I have a what was it called? I have a book where I took every trade I've taken for the past 1 year that I've backtested UPSD. I have written the things that happened when I was taking that trade, the reasons why I took a loss, the reasons why I made money, what happened at that point in time. When you record keep, which in other word we call post analysis, when you record keep, you have a book where you journal after taking a loss or a win in the market. It helps you understand your mistakes and what's made you make money in the market. Because knowing all of this, will help you know what to do in the market again and know what not to do. So this is very important. You can screenshot, you know, take notes, but have it in the back of your mind that this is how you're to set up your trading plan. So I'll give you guys an example. I will take a screenshot right now of my trading plan to show you guys what I mean by that. Okay, so a minute. So this is it here. Let me switch to Telegram so you can see what I'm talking about. Let me cancel all of this for those of you who want to, screenshot Telegram. This is my trading plan. You can see here, I have the market section, meaning the time I want to trade. I have the days I trade, which is the new news days. I have my strategy. I have the way I enter the market, and I have my risk percentage. I also have below it how I'm going to take profit and how I'm going to cut my losses short. So use this as an example for how you want to set up your own trading plan. And now this trading plan, how did I set it up? I set it up by an exercise that was on Trading in the Zone. That book